Welcome to the Finance Garage podcast, your go-to podcast for navigating the world of finance. I'm Jonathan, your financial guide, bringing the latest market trends, investment strategies, and financial news that matters to you. And by the way, I'm also going to share my other passion, which is cars.
At the SWU Group, we help everyday families achieve financial success. Our integrated services include financial planning, accounting, credit advisory, and estate planning. We're here to guide and support you every step of the way, from custom investment strategies to maximizing tax efficiency. We ensure your financial goals are met with peace of mind. Visit simonwu.com.au for more information.
Hey everyone, and welcome back to another episode of the Finance Garage. As always, Jonathan Wu, Senior Financial Advisor and Principal here at the SWU Group. Now today I've got a good friend of about 20 years, Louis Christopher, on the show, who's the Managing Director of SQM Research. Louis specialises in property data and the property market in Australia, and he's probably best known for his boom and bust report, which comes out every sort of November, forecasting what he believes is going to happen to the property market in the following year. I've asked Louis to come on the show to unpack his thoughts around the latest Australian federal budget and Chalmers and Albo's combined assault on the property market with regards to both a capital gains perspective as well as the negative gearing changes. The reality is that, and what I want to get to the bottom of, is whether or not these policies, in Louis' opinion, really gets to the key issue and potentially solves the key issue, being allowing young people to actually get into the property market. Because that's what's been touted, that's what's been marketed. But at the end of the day, there are two problems. We have a supply problem and we have a demand problem, both of which are different levers and requires different policy stances to effectively solve. And what we have noticed and what we have clearly seen in the last couple of years is that the supply of new property in Australia is the biggest issue, which is then coupled by a above average immigration or net immigration rate, which causes increased demand of property, but we just don't have the supply. And most recently, there has been some statistics that have come out with regards to the Melbourne property market, in which it is very difficult for a developer to justify a new start because the cost of building an apartment in metropolitan Melbourne is more than the value that you could potentially sell it for. And therefore, no one's going to build. So today we're going to pack a lot of these issues. We're going to discuss in detail what the mindset of a young person should be going to this market, and we'll see what comes out of it. So I hope everyone enjoys. Hey Louis, welcome to the Finance Garage.
Good to be with you, Jonathan. Been a while.
Yes. And now, obviously, this new budget has been very colourful. I've seen
the first budget I'm being aware of where the media is still discussing it many weeks later.
Usually it's about tobacco tax and, maybe some excise that's being wound back, and that's about it. And I think the best outline and the best introduction to this, our conversation today is government comes out with a budget. You talk to different people in society. I've talked to clients, that are richer, some that are not so rich. And usually someone's going to say, oh, this budget's been good for me. I have not had a single person that said this budget is good for me and for this specific reason. Mainly because I either don't get what they're changing. It's just a huge amount of stuff they're trying to change all at once. Mm-hmm. Or I know it's just bad for me because I have assets, I have trusts, or somewhere in the middle of that.
That's right.
How do you view these changes broadly?
Yeah, I agree with you. The reality is that the budget has not been good for anyone. Not good for the affluent, not necessarily good for the working class. You're right, anyone that's got an asset will be looking at this with a great deal of negativity. So yeah, and I think there is anger in the community from a broad spectrum, even in those from those on the left who would classify themselves as being on the left. I've personally seen anger on that front. Spoken to some of my more lefty friends, and they've quietly been bemused by the whole thing, and quite disappointed with it. From a professional perspective, if you come from the view of, okay, what we want to see in this country is an improvement in the standard of living, and you take the view that more taxes is not the way to go, and that's where I stand. I have a more of a free market capitalist perspective on a view on things with certain restrictions. We still need rules, we still need laws,
Yes.
we need oversight, but it seems to me that this is not going to help with productivity of Australia. And when it comes down to the property market, which I guess I've got a bit of a profile in, strictly looking at it, I'm not so sure it's going to achieve the objectives in terms of increasing housing supply. It may increase housing affordability. If you look at lower housing prices as improving affordability, but that comes with catches. So in short, the community has not taken this budget well, and there's good reason why.
I mean, we're recording this literally smack bang in the middle of June, and I still have clients, and obviously I think it's still being debated in its 2 days in the Senate at the moment with the changes. And broadly speaking, the biggest impact is, broadly, one, negative gearing, no longer applicable to existing housing, only applicable to new builds.
That's right.
And then the capital gains, basically from 1st of July 2027, the simple message is you have to basically take a value of the asset there if you hold an asset at that point.
That's right.
Revalue, have a valuation ready, old rules, new rules. If you buy something post 1 July 2027, you just have to worry about the new rules.
Yeah.
And you effectively need to be very convinced that your property won't go up by any more than inflation in order for you to minimize your tax.
Yep.
Okay. Now, one of the things about, Chalmers and Albo saying this is going to be good for young people is based on the fact of younger people will be able to afford, property because house prices are now starting to cave or starting to fall. Auction rates of, not great. But we've also heard at the same time that, these first home buyers are also a large cohort of those who are renting. And all these property investors are now jacking up rents. How does, in your read of data that you're seeing, does this actually help young people get into a better home if the financials don't stack up, given the fact that lower house prices but higher rent puts them in no better of a position?
Yeah, I think if you agree for the moment that most first home buyers out there, when they buy a home, they're going to be buying via lending.
Yep.
Right? They have to. One of the things that's occurred in all this is I think you'll find that the banks and financiers will be lifting their service requirements in all this. And I think that's already been happening.
Yes, it has.
So that in itself means that the serviceability or the income requirements and balance sheet requirements of your standard first home buyer are now higher than what they were before. So that is, as a result of these changes, will be a restrictive on first home buyers. The other thing too that first home buyers need to be wary of is what I've been discussing a fair bit over recent weeks is a risk of negative equity in this whole situation. So yes, the market may well become more affordable, but if you buy at the wrong time while it is falling and becoming more affordable, you have a real chance here that you will owe more on the property than what it is worth. Now, if you get yourself into that situation, your ability to take borrowings or, to borrow to buy a car, borrow to buy a business, borrow to buy anything has greatly reduced. All financiers will take into account your negative equity situation. I have noted that people have written in the media that this is just a paper situation only, like a paper loss only. Well, no, it's actually not. Negative equity does impact your ability to borrow money in the future.
Yep.
That is the harsh reality of it. And I regard it as being the second worst financial situation short of bankruptcy. So this is one of the issues for first-time buyers, and no doubt first-time buyers who took advantage of the 5% and down to 2% deposit scheme over the last 12 months, and particularly since October 25, where the scheme was expanded, could be sitting on negative equity as we speak.
100%.
And indeed, if our forecasts are right about what's going to happen this year for housing prices in Sydney and Melbourne in particular, we're going to see many, many thousands of first-home buyers at the end of this year being in a situation of negative equity.
Yep.
So that's not a good outcome for first-home buyers. And we can attribute part of that as a result of these taxation changes. Now, long-term, I agree that lower housing prices is better for first-home buyers, but the true optimal position for first-home buyers in a community is what you really want to see is a situation where incomes are rising faster than housing prices.
Yes.
That's the best goal and objective we can have. So in real terms, housing affordability does improve, but it's not at the trade-off of a destruction in wealth for everybody else.
I think if I draw a parallel to what we saw in China for many, many years, and I would sort of name this period in the 2010s to late 2010s, before 2020, we did see in second, third, and fourth tier cities, wage growth was faster than house price growth. So naturally, you have improved affordability. Right?
Yes.
We don't have that in Australia because of a number of reasons, including productivity, right? The productivity has been particularly horrible. And so the issue is that the government keeps pushing this idea. And I think what's been quite, what's come out of the analysis of late has been that this set of policies will achieve its intended purpose, but it will achieve its intended purpose 20 years from now. And that the current generation, the generation that has partaken in the property market, especially those with the 5% or 2% equity scheme, or now in this new set of rules, and they're still trying to pedal through that rat race to get to that first deposit, they're still going to be cut out of the market. It's their children that is probably going to be the beneficiary, because if house prices gently fall down and then these people start to enter the workforce, and at least, let's say there's no income growth, but then there's still property prices coming down, they will benefit. But you've got this purgatory generation that's lost. Can you see that?
I can see that, Jonathan, but I would like to point out to everyone listening that we think the adjustment period when it comes to the housing price change and a change in rents will actually occur over a shorter period.
Interesting. Okay.
So we think the adjustment will actually happen over the next 2 years, and then the market will find some type of equilibrium.
Okay.
What does equilibrium look like from a purely investment perspective, market perspective? Well, investors now will demand that property trades on a higher rental yield.
Yep.
Have to, right?
Yes.
Because of the tax benefit they have. And there's many overseas examples where, for example, countries that don't have negative gearing at all, they trade on a higher rental yield. That's what's going to happen here. Rental yields are going to go up. They need to entice investors into the market. And so what we will see in time is a lot more properties trading at a cash flow positive financial situation, for lack of better words. We think that adjustment is going to equate to about a change in yields of about 1.5%. So the average gross rental yield for a dwelling overall, houses and units combined, is roughly running at about late threes, 3.8, 3.9% as we speak, and we're expecting that number to get into the fives before investors are going to be encouraged to come in. Now, that's going to happen through a combination of housing price falls.
This is nationally.
Nationally.
Yep. Okay.
Plus rental increases. The two are going to happen simultaneously. They already were starting to happen because of the rise in interest rates, and we were already recording acceleration in advertised rents once again over the past 6 months. So the current trends are going to continue and will aggravate themselves as a result of the property taxation changes. And we did some modelling on this because it's not the first time Labor have come to the a view that they wish to make these type of property taxation changes. They brought in the notion of changing negative gearing as early as the 2016 election, which they lost.
Yes.
They tried it again in the 2019 election.
Yep.
They lost that again.
Yes.
And this time around, they're doing it without any announcement at an election.
Yes. Yes.
So it was always on the cards for them. But we did some modelling in 2019 surrounding their taxation changes, and we modelled out that we thought the adjustment period would run between 2 to 3 years.
Was your modelling based on policy that is quite similar to what they've announced, or more aggressive or more conservative?
What's actually been announced, which is the CGT change on top of the negative gearing, is more aggressive than what they actually came to the election in 2019 with.
Yep.
So if you recall, in 2019, they came to the election with negative gearing changes plus franking credits changes,
yes,
right?
yes.
So they've put the franking credits away and said, "Oh, we're gonna do CGT changes instead." So no, we didn't model the two combined. So arguably, you could logically rationale that the changes are going to be more heavier than what we forecasted back then. You could. We'll see. I think there's a lot of other mitigating circumstances around this. I mean, I personally think the probabilities of a rate cut are actually increasing once again. So we might see a rate cut over the next 2 years at some point.
Oh, over the next 2 years? Okay.
Yeah, not immediately.
Yeah, right,
I'm not one of the major banks saying the next move's going to be a rate cut. I'm not in that camp yet. But there is a chance, and so therefore the rental yield requirement to be higher might not be as aggressive as the 1.5% that I'm projecting.
So at the end of the day, you've got two causes of housing unaffordability. You have the demand and supply part, right? Each independent with its own individual levers. And you sort of already alluded to the supply part. One thing that I never understand is if we're so desperate for property and we're not building them fast enough based on the demand, should you literally just, and I think Angus Taylor came out with this as a policy alternative in his alternative budget, is just match net migration to new housing starts, and therefore you have some chance of creating a better equilibrium on house prices? Or just find a more practical way to get more houses out of the ground, because every developer is screaming, especially in Melbourne. I was looking at some numbers yesterday. There is almost no viable suburb in Melbourne where the cost of building an apartment is less than the price you could sell it for.
Yeah, correct.
Which is just earth-shattering in everyone's mind, given the fact that property development has historically been a pretty good business.
Yeah, no, that's very true, and that is true in terms of the state of Victoria. What's going on there? That basically pricing is getting to the point of being below replacement costs there.
Yes.
But that doesn't necessarily mean that we're expecting housing prices to rise anytime soon in Victoria because of the state of the economy. That may all change if we see a state of government, mind you. Look, going to the supply-demand question, we are believers that they represent two levers to pull economically. You can pull the demand lever, you can pull the supply lever through changes in taxes and so forth. You can pull both. And I do believe it's a demand and supply issue. The truth of the matter is that the ABS shows that through the 12 months to, I think it's March, that the population expanded again by some 500,000 people. Now, to meet that type of new net demand expansion, you need to build somewhere around 190 to 210,000 dwellings a year. Our long-term average since the beginning of 2000s, we've been building roughly around 170. And there is an argument that, okay, our capacity is arguably higher than that we can do a better build rate, arguably, but we've never been able to sustain it. So I think 1 year we built about 220,000 dwellings in a single year. That was 2017. Recall Labor's target to build 1.2 million dwellings by 2029. That was, if I recall, over a 5-year period, and that meant that we would have had to have built 240,000 dwellings a year. Now, if we did that, based on the current population expansion, we would actually see an easing in the rental market. We're not going to build that. Like it's already for the record. We're just nowhere near that number that Labor's targeting. And the truth of the matter is that we're going to be roughly around our long-term average of 170,000 dwellings. So Labor's attempts to change things in terms of build to rent and so forth haven't really amounted to much so far in terms of what's been happening on the ground. So let's assume for a moment that our long-term capacity to build, based on everything we know about the building market, is roughly around 170 to 190. We do, on that premise, we have to bring the population growth rate down. We just do.
Yep.
Somewhere down towards, I think, net of everything, high 300s would get us back to an equilibrium between demand and supply. So that involves cuts in migration. We know that Labor have been stating on record they've got a target. It's in their federal budget numbers. So in terms of migration cuts, so far they really haven't hit it.
Yep.
We have come off the peak, but not those budget target numbers.
But that peak was also artificially higher because of COVID.
It was artificially
800 or whatever.
That's right, but we've come off very slowly since then. We could have come off at a quicker rate, and we didn't.
Yes.
And that's created the problems in the rental market that we've seen. When you consider the various policies of the Liberal National Party, the One Nation Party, of course, One Nation's got a far more aggressive policy of reducing migration to 130,000 a year. Now, if that policy was actually enacted, that means that we would only need to build roughly between 90 to 100,000 dwellings a year, half our capacity, half. We don't need to cut migration to those levels to get ourselves back into capacity. We just don't need to do it. The Liberal National Party's policy, I think, in terms of migration, is to cut migration down to, I think, 220,000. On that number, if I calculated out, we would have to build somewhere around 135,000 dwellings a year, once again, well within capacity.
And it would help the current deficit.
It would help.
Yes.
So arguably the LNP's policy makes more sense out there at this point in time. I think One Nation's policy potentially has a risk of literally putting the country in recession if we're not careful. Not that I'm a great believer that, okay, you need strong migration to buffer up the economic numbers. You need strong productivity. You don't necessarily need strong migration to get strong productivity. In fact, one can negatively affect the other.
Yes.
But yeah, I think, if One Nation were to get up and, the polling at the moment suggests that they've got a real chance of forming government somewhere, that there are risks there in terms of going too hard the other way on migration.
You don't think that the current policy stance, not taking the One Nation extremity, would not cause a potential recession?
You mean the policy stance around taxation? Yes, I think there is a risk of that as well.
Okay.
No, I'm in the camp right now that we are at real risk of going into a recession, and indeed the March quarter, we only grew by 0.3%, and on a per capita basis, we were negative once again.
And that's before any announcements.
That's exactly right. And that was the March quarter.
Yep.
Remember the war in the Middle East only started at the beginning of March.
Correct.
So I think we'll see the full impacts upon the economy in the June quarter read. So don't be surprised if we see contraction in the June quarter.
Going back to the first home buyer question, what do you think a first home buyer does now when faced, and let's just take the assumption it's going to get through Senate in its current form, otherwise we'll be here for days, but let's just say it goes past in its current form. What does a first home buyer do?
first home buyer gets their budget in order, gets everything ready to go, but takes their time. Okay, so
Wait the 2 years. Like what? Wait.
yeah, I don't think there's any rush to get into the market. Let's think about this. Are there any sweeteners on the horizon right now which will suddenly turn the housing market around, macro speaking? No.
I can't see it.
I can't see the Labor government suddenly changing
No, they won't.
their direction. They won't do that. Can we see the RBA cutting interest rates shortly? No. The best they'll do is they'll pause. I still hold that they maybe cut at some point in time if we do go into recession. But that's the other risk for the housing market. If we go into recession, that means a rise in unemployment.
Yes.
A rise in unemployment means there'll be more distressed selling out there and less buying, which could send housing prices further down. And it goes back to my point that, okay, as a first home buyer right now, you buy into this market, you are catching a falling knife.
Yes.
And is that something you really want to do? Yes, it is a buyer's market. It's a buyer's market for a reason. No, I think optimally for any buyer, and I'm only saying this from personal experience, the best time to buy is after the bottom.
Of course.
Don't try and pick the very bottom. Buy after the bottom.
Like stocks.
Yes. Well, the thing is, the beauty of the property market versus stocks is, as we know, trends in the stock market can be rather choppy, and you can get a lot of false reads.
Yes.
Whereas the housing market, the trends there are more concrete. That's what I found, and that's what's always helped me in terms of my reasonably accurate predictions on the housing market, is that the trends there are more concrete, and you can pick the turning points a little bit more easier than what you can do in equities.
How does, when you are doing your modeling and your analysis,
Yeah.
and every year I read your report that comes out, which is the boom and bust report.
Well, we didn't pick the wall last time.
I have no idea why you didn't. I mean, Louis, clearly there were signs that, Donald Trump is continuously mad. But does a policy stance or change of policy stance as big as the one that we've just seen move the trend through all these decades that you've analysed property in a way that you think it will buckle either way? Right.
Well, I'll tell you what I think. I don't believe in 7-year cycles. Like you hear this occasionally, the property cycle.
Double every 7 years.
That's crap.
That's right. Yep.
So the reality is the market does respond to new information, whether that be taxation policy changes, monetary policy changes. It changes based on what's going on in the economy. And certainly the economy doesn't run on a 7-year cycle. So when I do our forecasting for each and every year, I spend a lot of time on two factors. Firstly, what are our leading indicators? So as you know, we publish a lot of leading housing market indicators such as auction clearance rates, stock on market, asking prices, rents and so forth. I look at those very, very closely indeed. Then I look at a number of longer term factors. Well, what is population growth doing? Are we expecting to see a change there anytime soon? Then I look at what the money markets are pricing in and what the RBA has been talking about. Can we expect a rate cut? What are the odds that the RBA will start hold, or could they rise? Could they lift interest rates? So I look at all those factors, and then I come up with my scenarios, and then we put our hat on what we put down as a base case scenario. This year, I've had to do something very unusual, and that is I've had to revise our forecasts. So normally we don't need to revise our forecasts because we have about 4 scenarios.
Yep.
And normally what happens is that the economy plays out to one of those 4 scenarios. Not necessarily our base case, but it will follow one of our 4 scenarios. Last time I had to do a revision on our forecasts was 2018. So we released our original forecast in November, where we were forecasting essentially that rates would be stable and or we might see an interest rate cut. We didn't have in our top 4 scenarios that we would see an interest rate rise. So when it came through in February, we had an interest rate rise, we moved towards revising our forecasts. So we just update our audience. And so we shortly revised our forecast, and we moved from Sydney and Melbourne recording essentially very low single digit growth, that's what we originally forecasted, to housing price falls. And then we had to do a further revision on the property taxation changes. That was one factor, again, which we did not forecast for 2026. And it's a major factor that does have an impact upon housing prices. So when that came out, we revised one more time, and I'm hoping that it's the last revision we have to do, unless there is an announcement of aliens or something like that. I don't know. But we revised downwards our pricing for Sydney and Melbourne, that Sydney would fall by up to 9% this calendar year, and I think we're on track for that now, and Melbourne would fall by up to 7%. And as mentioned up front, if we see those forecasts come in, and I'm pretty confident that's what's going to happen this year, you're going to see a lot of first-home buyers underwater.
Yeah. Actually, when you made the comment just then about negative equity is only second worst to bankruptcy, I can, now see it. Yeah.
It's not good. I mean, I got SQM Research going essentially on the back of my house, the equity I had in my house. The banks would not lend to me unsecured to get SQM
As a
Research
business
going.
loan. Yep.
They just don't anymore. You need equity in a home.
Yep.
That's how I got a business going, and that's how anyone out there listening to this now wants to get a small business going. The reality is you'll probably have to borrow money, and to do that, you're going to have some equity in a home. So to have a situation where you have negative equity in a home, you can see straight away it's going to restrict you in terms of doing a lot of things in life.
And that even in itself, although you can arguably say that is a small demographic of people, right? In terms of the overall housing market.
Yeah,
right?
look, the first home buyers of 2020 would still be in positive equity today.
Correct. But having, those buyers potentially forcibly selling for whatever reason because they've got themselves into these schemes, that, is going to be a problem in overall confidence because they may not move the Richter, but all they see their friends selling, and they're of the same generation Z or whatever you call the next one, I've lost track. There is a domino effect of this sentiment for young people.
Yeah, there is. Look, when you think about it, you're not going to be forced to sell a home unless you're about to lose your job.
Yeah, correct.
So there is an argument that, and a solid argument that, you ride through this storm, you accept the fact you might be in negative equity, you pay down as much as you can at a quicker rate than what you were anticipating, if you can, and you will eventually get yourself back into positive value, and there'll be a time when the market picks up again.
Yep.
And that nightmare will be over. But we just don't know how long is a piece of string. We don't know how long this is going to go for. We don't know if it's going to get materially worse. We have spoken about the fact that the probabilities of increase will have a recession. I agree with that. That could make things materially worse. So yeah, it's a difficult one. I agree with you that it's no doubt contributing to the very negative consumer sentiment we've been seeing in the surveys. They've been extraordinarily negative. We're talking about as bad as they were back in the 1990 recession. That's how bad these consumer sentiment surveys have been. Really, really negative. So I wouldn't be surprised if we do see a rise in unemployment as a result. And if you do get a strong rise in unemployment, there will be more forced selling.
Would that trigger you to revise the numbers again?
Holy crap, I hope not. Look, I think in that scenario, for a calendar year, keep in mind we're forecasted for a calendar year.
Yes.
It's very rare for a market to fall more than, say, 9 or 10% in a single year. But can it happen over multiple years where we have down 9% one year, down 8% another year, down 8% again the third year, for a collective peak to trough decline of something along the lines of 20 to 30%? That is possible.
Yes.
And it is also possible in all this we will see One Nation get up. We know where they stand on migration. If we were to see that happen in, say, 2028, that would put downward pressure on housing prices. I've no doubt about it. So there is a scenario that plays out here where this downturn goes on for an extended period. I'm not saying it will. I don't know the future. I don't know if One Nation's going to get up. I don't know for sure if we're going into recession. All we can do is look at these from a financial professional's perspective, the probabilities of these events occurring. And all I'm saying is, well, it looks like the probabilities have increased. We might get a recession. It looks like the probabilities are increased that these property taxation changes will be with us for the next 2 years at least. There is a heightened probability now that there's so much community anger that we're going to have a hard right government get in power and really smash migration.
Yep.
And they may well repeal. They may well repeal the property taxation changes with it. And then it'll be a question of what is the greater force, the big drop in migration or the property taxation changes or a better economy. So I don't want to put the boot into one nation, but I'm just aware that, okay, big cuts in population growth, there are precedents out there. You look at what's happened with Canada's housing market where they have cut back strongly migration, what happened in Japan, it was more of a natural thing because of natural population decline. Your population growth is definitely a huge causation of and driver of housing prices. That is a fact.
Ready to take the first step in investing, or just looking to continue growing your wealth without being inundated with financial information? With SWU Online Invest, we offer a range of expertly managed portfolios designed to match your investment needs. Whether you're a seasoned investor or just getting started, know that we will work tirelessly to ensure your investments are strategically positioned to maximize your goals. Visit swuonlineinvest.com.au today.
Just to finish off, you're a small business, operator and in the SME market, which, so am I. And, we're collectively, 90% of the employees of this country. I personally think that, and I recorded a podcast on this last week, I think there's a real risk, and I think it's more than 50%, that we're just going to kill off entrepreneurship with the capital gains tax changes.
Yeah.
That's just going to do even worse things for productivity. That's going to do worse things for innovation. We already don't have a manufacturing sector that exists in any material fashion in this country. How do you see that one playing out? Because I heard Naomi, what's her name? The person who created Red Balloon on Mark Boris's podcast the other week. And she said, forget about any political lines that, you're left or right or whatever. You objectively view around the world how capital gains taxes are captured. If you have initially captured the majority of tax upfront through the consumption side, being income taxes, you're using that after-tax money to then invest, and you're trying to find ways to incentivize people, whether it be incentivize people to invest into businesses, incentivize people to start businesses, and to take on all those risks, which we know the red tape in Australia is already at a point where it's, making cafes untenable. Doesn't this put us final stake in the ground going, what's the point of taking business risk going forward? For anyone looking at it.
Yeah, absolutely. It is a factor. I mean, to be fair, it is not impacting the numbers in terms of trying to get a business going. It's about what happens if you're actually successful with a business in terms of how much the government takes. And certainly that impacts upon the probabilities and the return payoff if your business is successful. Would have it changed my view in terms of getting SQM Research going? Probably not in the scheme of things.
Okay.
Because I've always had a passion to get my own business going. But I can see how it does impact upon others, and importantly how people structure their startups and where they structure it from. I mean, hey, New Zealand's only 3 hours flight away from here. Yeah. And so this notion that, okay, entrepreneurial people may well take their business elsewhere, I think is a great risk. And I agree with that notion. But you can also have a perspective that sooner or later, the probabilities are high that these taxation changes may be reversed out.
Correct.
And getting a business going is a long-term proposition. I've been at it with SQM Research now since 2006, so we are in our 20th year.
Correct.
And I think that's how you need to look at business perspective, that it is definitely a long-term proposition. So with that in mind, I don't think people necessarily should move elsewhere, but I can understand why people would.
It's that incentiveness. I think if I draw another interesting observation that I've seen in the last literal just couple of days, where people go, okay, so if originally my thesis was I buy residential property, negatively gear it because the capital gains are so strong, I believe in the myth that every 7 years it doubles, right? Or every 7 years there's a cycle, whatever. Now, given the fact that the cap growth part of it, I'm disincentivized to find assets that are high growth. So I'm going to go buy commercial property instead because yields are higher, capital growth is lower, broadly speaking. And then I'm going to get better bang for my buck because as long as the commercial property that I buy, the warehouse or whatever is a mum and dad that I can afford, only goes up by about the rate of inflation, then at least I'm getting paid off as an income annuity investment.
Yes.
Right? And so, to that point, people will still stay in the country, but they'll pivot.
Yeah, I could see that.
And businesses might, have that same thing. If I can create a business that's more about annuity income rather than cap growth, now unfortunately that kills off tech startups and things like that, right, where their cost base is zero. But it might cause the economy to change in ways that the government, I don't think, expected.
Yeah, I agree. And one of those, for example, going back to the negative gearing and the capital gains tax changes, is the impact upon state government stamp duty revenue.
Yeah.
So one of the factors we believe is happening right now is that there's a big fall off in sales turnover. You see it in the auction clearance rates, where we've been recording clearance rates in the 30s for Sydney, as an example, and early 40s for Melbourne. So big falls in sales turnover. What's one of the biggest contributors to state government coffers? It's state stamp duty on residential property, worth around the country about $30 billion a year in revenue. We think the sales turnover is going to be, in terms of the drop, it's going to fall by about 25 to 30%.
Wow.
And so for a number of state governments that were forecasting a surplus for FY27, that's going to fall back into deficit again. So that's one of the factors which I don't think has been discussed in great detail in Canberra. But there has been, I think, a number of premiers that have come out in a recent week to say we're getting hit on the state government stamp duties. And yeah, they are. So that's, you agree that there are these X factors that perhaps have not been modelled out, have not been thought about. And clearly some of the forecasting in terms of rents are only going to rise by $2 a week as a result of this, some of that's sort of crap.
That's crap.
It's already happened.
Well, yeah, correct. Correct. I think that, we were talking earlier before, we hit record talking about finding silver linings and challenges, right? I know this sounds somewhat perverse, and probably, my audience probably won't like to hear this, but everyone knows I'm very open and frank about my views of things. We genuinely have not had a recession since the recession we had to have in 93.
I have to correct you. We briefly had one during COVID.
Oh, during COVID, sorry. Yes,
but the impact upon that wasn't as heavy as what a normal recession brings.
Correct. Because we didn't have a recession in 2007 with the GFC.
Correct.
And so we sort of missed that. So, in 1993, I was 8 years old.
Yeah.
So I saw some bits of it through my parents, but obviously nothing that would materially impact the way that I've acted or done certain things for the rest of my life so far. I think that the silver lining in us having a proper recession for the first time in, 30 odd years would be the fact that it knocks people out of complacency broadly.
Yep. There is a forced productivity improvement that occurs. It's done very painfully, but it does happen. That's what happened in the 1990 to 1992 recession, which of course had lingering effects beyond 1992,
Correct.
was that there was a massive increase in productivity.
Correct. So I'm hoping, for the sake of Australia, a country that I was born and I love, that we finally do have a productivity spike and not just a nominal growth in GDP through net migration.
Well, we may well see it through what's going on with AI.
Oh, yeah, true. Yeah.
And look, that may well also be painful in terms of job losses. And
Yes.
I think this time round with this increase in technological advancement, that we may well see some job losses, and I think it's already happening. We should see a productivity improvement.
Yeah.
I'm seeing it personally in my business.
Yeah.
We use AI, and it's definitely helped us in terms of research insights and the ability to double check, cross check information points, which
the speed of which
we're doing it, and IT development speeds picked up. So we're definitely seeing a productivity improvement as a result of AI. And if we're seeing it, others should be too.
Yeah. And on that, I guess, somewhat positive note, Louis, thank you very much for your time, and hope to see you back on the show soon.
Thank you. It's good to be with you and your audience, Jonathan.
This podcast is not financial product advice and is intended to provide information only. It does not take into account the investment objectives, financial situation, or needs of any person. You should assess whether the information is appropriate for you and consider talking to a financial advisor before making any investment decisions. Any investment examples are for illustrative purposes only. The information is taken from sources which are believed to be accurate, but Simon Wu, Jonathan Wu, SWU Financial Planning, and Personal Financial Services Limited accept no liability of any kind to any person who relies on the information contained in the podcast. Unless expressly stated, none of the information should be taken as a recommendation. For more information, please visit www.simonwu.com.au.